Have you ever done the real math on your day? If you wake up at 7 in the morning, spend an hour getting to work, work 8 hours, and then spend another hour getting home, you have given 10 hours of your day to earning money. 10 hours, that is not just work. That is the largest block of your waking life. But while you are doing that, what is your money doing? For many people, the answer is almost nothing. It sits in a bank account, it earns a little interest, it waits, it sleeps. And while your money is sleeping, inflation is awake. That is the imbalance most people never examine. They work aggressively for money, but they never build a system where money works for them. And when you understand that difference, the whole financial game begins to change. I am not talking about day trading. I am not talking about chasing hot stocks. I am not talking about staring at a screen all day trying to guess what a chart will do in the next 10 minutes. That is not a system for most people. That is stress dressed up as investing. What I want to talk about is much simpler. If you had $10,000, how would you structure it so that it did not just sit there losing purchasing power? How would you turn it into a system? How would you make that money begin to work without forcing you to become a professional trader, without forcing you to obsess over the market every day, and without building a life where your investments make you more anxious than your job? That is the question, because $10,000 is not just a number. It is a threshold. It is the first amount that can make a person feel, often for the first time, that money can become a worker. Not a massive worker yet, not a worker that replaces your job tomorrow, but a worker. And that shift matters. The core idea is simple. Make your money work for you instead of spending your whole life chasing money. Most people hear the word investing and immediately imagine risk. They imagine losing everything. They imagine charts, screens, volatility, complicated terms, and the feeling that they are not smart enough to play the game. I understand that fear. But the fear often comes from confusing investing with speculation. Speculation is trying to get rich quickly by predicting what other people will do next. Investing is building a durable system that gives productive assets time to compound. Those are very different things. A proper asset allocation system should feel more like setting a washing machine than fighting a battle every morning. You choose the right cycle, you load it correctly, you press start, then you let the process run. You do not open the machine every 30 seconds and panic because the clothes are wet. Investing works the same way. You design the system, fund it, automate it, rebalance it, and let time do part of the work. If your investments keep you awake every night, that is not financial planning, that is a system mismatch. The goal is not to create more anxiety, the goal is to create more freedom. Now imagine you had $10,000 right now. What would you do? Would you leave it in checking? Would you put it in a fixed deposit? Would you buy some insurance savings product? Would you keep it in the bank because at least it feels safe? That is what many people do. They work hard for years, save slowly, and then let their savings sit in a place where inflation quietly eats the purchasing power. It feels safe because the number on the screen does not fall. But safety is not only about the number of dollars. Safety is also about what those dollars can buy. If the account still says $10,000 but the cost of everything around you rises, then the real value of the money has gone down. That is not safety. That is a slow leak. It is like carrying water up a mountain without realizing there is a hole in the bucket. You are working hard, you are tired, you are disciplined. But the system is not preserving the value of your effort. Before we talk about what to do with $10,000, we have to clear away 3 myths, because these myths stop people from acting. The first myth is that investing is dangerous and saving is safe. That sounds logical because the bank account does not move around like the stock market. But the real world is more complicated. If inflation is around 3.3% and your bank interest is around 1.9%, then your money is losing purchasing power by roughly 1.4% per year. You may not see the loss on the statement, but you feel it when groceries cost more, rent costs more, insurance costs more, and the same cash buys less. Over 10 years, the purchasing power of $10,000 can fall meaningfully, even if the account balance appears unchanged or slowly grows. So the question is not whether saving is safe. The question is safe from what? Safe from market volatility, perhaps, but not safe from inflation, not safe from the rising cost of life, not safe from losing purchasing power quietly over time. That is why I think people need to distinguish between nominal safety and real safety. Nominal safety means the number does not fall. Real safety means the money preserves or grows its ability to buy the things you need. Cash is useful, cash is necessary. Cash gives flexibility, but cash is not a complete wealth strategy. The second myth is that you need a lot of money to start investing. Many people think investing begins only after they have hundreds of thousands of dollars. That belief delays action. The truth is that $10,000 is a very good starting line. It is large enough to build a structure. It is large enough to create a psychological shift. It is large enough to divide into different functions. but it is not so large that you need to feel like only wealthy people can use the method. The amount matters less than the system. If you go to the gym, you do not refuse to train because you only have 10-pound dumbbells. You use the dumbbells to build the habit, improve the form, and strengthen the body. Investing works the same way. Your first $10,000 is not the end goal. It is the training base. The third myth is that investing means you have to spend your life researching individual stocks. If you are a professional investor, research may be your work. But for most people with jobs, families, health concerns, and lives to live, your time is too valuable to spend 3 hours a day trying to pick stocks. Most people do not need to beat the market through cleverness. They need to participate in the market through discipline. That is a different objective. The essence of passive investing is accepting that the market is bigger than you, faster than you, and often smarter than you in the short term. So instead of trying to outguess it every week, you join it, you own broad exposure, you automate, you rebalance, you let time and diversification do what emotions cannot do. Now, why does the $10,000 number matter so much? Because it is a psychological threshold. When your account reaches 5 figures, you begin to see your money differently. It is no longer just cash waiting to be spent. It becomes capital. If a $10,000 portfolio earns 6% in a year, that is $600. That averages to $50 a month. Now, $50 a month will not make you financially free tomorrow. But the source of that $50 matters. It was not earned by commuting. It was not earned by meetings. It was not earned by giving 10 hours of your day to someone else. It was earned by capital. That changes how a person thinks. The first time you see dividends or interest or portfolio growth appear without additional labor, you begin to understand passive income emotionally, not just intellectually. It is like planting a tree. At first, the tree is small. You cannot sit under it. It produces no shade. It does not feed you. But if it is healthy and you let it grow, it becomes larger every year. And one day it produces fruit. That first fruit changes how you see the tree. The $10,000 level can do that for money. It can make the idea of ownership real. And once ownership becomes real, people begin to behave differently. They begin to ask better questions. They begin to see wages and assets differently. They begin to understand that the goal is not only to earn money, but to build a machine that can eventually produce money. So if asset allocation is simple, why do most people fail at it? They fail because they do not have a system. They watch a video and buy one stock. They hear a friend mention a fund and chase it. They read a headline and panic. They invest once, forget the plan, and then react emotionally when the market falls. That is not a system. That is random action. It is like wanting a healthy body, running 10 miles one day, then doing nothing for 3 months. The problem is not effort. The problem is inconsistency and lack of structure. A system gives every dollar a job. It tells you what to do before emotion arrives. It tells you where money goes, how much risk you are taking, how you buy, how you rebalance, and what you do when markets fall. That is why I like dividing the $10,000 into 3 layers. The first layer is the safety net. I would hold back 20% or $2,000 as an emergency reserve. This money is not for investing. It is not supposed to produce high returns. It belongs in a high-yield savings account, a checking account, a short-term deposit, or another safe and accessible place. Some people will look at that and say that money is not working hard enough. I see it differently, that $2,000 is working as psychological insurance. It protects the rest of the plan if a pipe bursts, if the car breaks, if work is interrupted, if life creates an unexpected bill. You do not want to be forced to sell your investments at the wrong time. Many investors fail not because they choose terrible assets, but because they have no liquidity. An emergency arrives and they have to sell during a downturn. That turns volatility into permanent loss. The safety net prevents that. It allows you to let the rest of your money work because you have some cash ready for life. This is not wasted money. It is the base of the structure. Think of it like running a marathon. If you sprint at the beginning and have no energy later, you do not finish. The reserve is what helps you keep pace when conditions change. The second layer is the growth engine. This is the core of the portfolio. I would put 60% or $6,000 into long-term growth assets. The purpose of this part is not short-term excitement. It is steady compounding over time. A simple structure could use a combination of broad stock market ETFs and bond ETFs, for example, of this $6,000 growth engine. 70% could go into broad market stock ETFs such as global or U.S. total market funds, and 30% could go into bond ETFs or investment-grade bonds. The specific ETFs can vary. The principle is what matters. Stocks represent growth. Over long periods, broad stock markets have historically generated higher returns, often around 8 to 10% annually in many long-term examples, though not in a straight line and never with guarantees. Bonds represent stability. Their expected returns are lower, often more in the 3 to 5% range depending on the environment, but they can help reduce portfolio volatility. In some market downturns, bonds may hold up better than stocks or provide a stabilizing force. When you combine stocks and bonds, you are not trying to maximize every possible return. You are trying to build a portfolio you can actually hold. That is important. The best theoretical portfolio is useless if you abandon it during the first serious decline. A 70-30 mix is not perfect for everyone, but it illustrates the idea: growth with stability, upside with a cushion, participation without reckless concentration. And there is one more key point. Do not obsess over buying at the perfect bottom. Timing the market consistently is extremely difficult, even for professionals. Most people cannot do it. Many people damage themselves by trying. A better approach is dollar cost averaging. Instead of putting the full $6,000 into the market on one day, you can divide it across 6 months and invest $1,000 per month. That way, if the market goes down after your first purchase, you buy more at lower prices. If the market rises, at least part of your capital is already invested. You reduce the emotional burden of having to pick the perfect day. The goal is not to win every entry point. The goal is to build a process you can follow. The third layer is opportunity bullets. This is the final 20% or $2,000. The purpose of this money is flexibility. It is there to buy more when the market falls significantly. My personal framework would be that if the broad market falls more than 15% from its peak, that is when this opportunity money begins to be deployed in batches, not all at once. In batches, why keep opportunity money at all? Because market declines are part of the system. They always feel frightening when they happen, but they also create opportunity for people who have liquidity and a plan. When everyone else is panic selling, cash becomes a strategic asset. But what if the market keeps rising? Then the opportunity money may lag. That is the trade-off. You can keep it in a money market fund or short-term instrument, so it still earns something while waiting, but it may not earn as much as stocks during a strong market. That is acceptable because the money has a different job. The safety net protects you from emergencies. The growth engine compounds. The opportunity bullets give you the ability to act when prices fall. Each layer has a purpose. That is the point of asset allocation. It is not just owning different things. It is assigning different jobs to different parts of your capital. During the 2022 market decline, a structure like this would have mattered. Many people were panicking, many were selling, but someone with opportunity cash and a clear rule could look at the decline differently. Not as the end of the world, as a chance to deploy capital into lower prices. That psychological advantage is extremely valuable. When you have no cash, a crash feels like a threat. When you have a system and opportunity money, a crash can also feel like an opening. Same market, different structure. Now, how do you execute? The first step is to open a brokerage account. Today, this is easier than ever. You can usually do it online with identification, bank information, and basic personal details. The process can take a short amount of time depending on the broker. When choosing a broker, focus on simplicity, low costs, reliability, and access to the kinds of ETFs or funds you want to buy. Most major brokers now offer commission-free ETF trading, which removes a friction point that used to matter more. The second step is to set up automatic transfers. This is critical because human nature is unreliable. If every month you have to decide whether to invest, emotions will interfere. There will always be a reason to delay. The market feels too high. The market feels too low. Work is busy. A bill came in. The news is frightening. You forgot. Automation removes that friction when money moves automatically after your paycheck arrives. The system acts before your emotions negotiate with it. After a while, you adjust to the new cash flow. That is how habits become structures. The third step is to choose the ETFs or funds. If you genuinely do not know what to choose, the simplest starting point is often a broad total market ETF or an SP 500 ETF. Examples might include funds like VTI or VUO, depending on your goal and platform. Do not waste months trying to find the single best fund. There is no perfect asset. There is only what is suitable for the role you need it to play. For the growth engine, broad low-cost funds are often more useful than complicated products because they allow the investor to stay focused on the system rather than the noise. The fourth step is rebalancing. Rebalancing means bringing the portfolio back to its target weights. If you start with 70% stocks and 30% bonds and stocks rise faster after a year, you might find yourself at 80% stocks and 20% bonds. That means your portfolio is now riskier than the plan intended. To rebalance, you sell some of what rose and buy some of what lagged, returning to 70 divided by 30. This can feel counterintuitive because you are selling winners and buying laggards. But that is the discipline. Rebalancing forces a version of sell high, buy low. It prevents the portfolio from drifting into a risk level you did not choose. Doing this every 6 months can be enough for many simple systems. It does not need to be obsessive. It can take less than 30 minutes. The purpose is not to create activity. The purpose is to maintain the structure. The fifth step is to keep learning but not overreact. Investing is a lifelong process. You should learn. You should understand inflation, interest rates, markets, and basic portfolio principles. Spending 1 or 2 hours a month reading and learning can be useful. But learning is not the same as constantly changing. Many retail investors underperform the market because they trade too often, react emotionally, chase performance, sell during fear, and buy only after assets have already risen. The most boring strategy is often the most effective. Buy, hold, rebalance, keep contributing. That is not exciting, but wealth is not built by excitement. It is built by repeatable behavior. Now, what kind of return could a system like this produce? Historically, a 70 divided by 30 stock bond portfolio has often produced long-term annualized returns around 6 to 8%, depending on the period. The exact assets, inflation, interest rates, and rebalancing, there are no guarantees. But let us use 7% as an example. If you invest $10,000 and it compounds at 7% annually, it becomes nearly $20,000 in 10 years. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. That is only the initial $10,000. Now add ongoing contributions if you invest that $10,000 and then add $200 per month for 30 years. The total can grow to more than $300,000 under a 7% assumption. That is the power of compounding. The later result is not driven only by the initial money. It is driven by the combination of starting capital, ongoing contributions, reinvestment time, and return. This is why people who say $10,000 is not enough are missing the point. $10,000 is not enough to retire on, but it is enough to start the machine. And once the machine is running, contributions and time matter enormously. Compounding is not magic, it is mathematics plus patience. But mathematics only works if behavior allows it to work. And this is where most people struggle. You will experience market crashes. You will see paper losses. There will be months or years where the portfolio feels disappointing. If you invest long enough, your account will eventually show a decline that feels uncomfortable. That is normal. During the COVID crash in March 2020, many portfolios fell sharply. A 30% decline can feel terrible. It tests whether your plan was real or only theoretical. If you sell in the panic, you turn temporary volatility into permanent loss. If you have a system, you already know what to do. You continue buying. You rebalance if needed. You deploy opportunity cash according to your rules. The market is not your biggest enemy. Your emotions are. That is why the system matters. A system makes decisions before the emotional moment arrives. If you wait until the crash to decide what kind of investor you are, the crash will decide for you. The system is your defense against yourself. Now, I want to add a very important point. Do not treat investment returns as your only source of wealth. Your human capital is often your biggest asset. If you are 30 years old and earn $60,000 a year until age 65, that is more than $2 million in lifetime wages before considering raises. That means your ability to earn, learn, grow, and increase income is one of the most powerful assets you have. Investing helps your money work for you, but investing in yourself helps you create more money to invest. These two things work together. If you increase your income from $60,000 to $120,000 and keep lifestyle inflation under control, your ability to invest can increase dramatically. That accelerates the compounding process far more than trying to squeeze an extra 0.5% from a fund choice. A person with a strong income, disciplined savings, and a simple investment system can build wealth faster than a person who spends all day optimizing investments but never increases the amount they can invest. So the system is not only about assets, it is about the whole life. Earn more. Spend less than you earn, build a safety net, invest consistently. Keep opportunity cash, rebalance, increase your skills. Repeat for decades. That is the flywheel. Now let us summarize the allocation again. From $10,000, 20% or $2,000 goes into the safety net. This is not for return, it is for resilience. 60% or $6,000 goes into the growth engine. This is long-term money allocated across broad stock and bond exposure, perhaps through a 70 divided by 30 stock bond structure. 20% or $2,000 stays as opportunity bullets. This money waits for significant market declines, perhaps more than 15% from a peak, and can be deployed in batches when fear creates lower prices. Then you automate contributions, you dollar cost average, you rebalance every 6 months. You keep learning without overreacting, you focus on increasing your income and your ability to keep adding capital. You do not expect to get rich overnight. You build a system that can give you a real chance at financial freedom 10, 20, or 30 years from now. The most important benefit is not only the money, it is the reduction of anxiety. If you have a system, you do not need to wake up every day and ask what the market is doing. You do not need to compare yourself to people on social media. You do not need to chase every hot stock. You do not need to pretend you can predict the next headline. You have a plan that creates mental space for the things that actually matter: your health, your family, your career, your relationships, your learning, your life. Money should serve those things. It should not consume them. Now, I know taking $10,000 of hard-earned money and putting it into a structured investment plan can feel frightening. That fear is normal, but ask yourself this: if you do nothing, what happens? If the money stays in the bank earning too little while inflation continues, how much purchasing power will be lost in 10 years? Inflation does not wait until you feel ready. Markets do not wait until you feel perfectly confident. Financial life moves whether you act or not. Not acting is also a decision. It is the decision to let the current system keep working on you. When you invest responsibly, you are not eliminating risk. You are choosing a different kind of risk. Cash has inflation risk. Investments have volatility risk. Debt has interest rate and cash flow risk. Work has income risk. Life has emergency risk. There is no risk-free path. The objective is not to avoid all risk. The objective is to structure risk intelligently. That is what asset allocation does. It says, I will not put everything in one place. I will not depend on perfect timing. I will not let inflation eat all my cash. I will not invest every dollar and leave myself no emergency reserve. I will not panic when markets fall because I have opportunity money. I will not chase complexity when simplicity can work. That is a much better system than guessing. Now, one of the reasons people delay is that they think they need to feel ready. You will almost never feel completely ready. There will always be uncertainty. There will always be a recession risk. There will always be an election. There will always be a war somewhere. There will always be inflation concerns. There will always be a reason to wait. The second best time to build an investment system is when you understand that waiting has a cost. You do not need to begin with everything. You can begin with a smaller amount. You can start with $100 a month. You can start with $200 a month. You can start with the portion of $10,000 that fits your situation. The point is to build the habit and structure. Once the structure exists, increasing the amount becomes easier. A system can scale. No system cannot scale. This is why action matters. Spend time understanding your current assets. How much cash do you have? How much debt do you have? What are your fixed expenses? How much can you safely invest? What amount belongs in the safety net? What amount can become the growth engine? What amount should be opportunity cash? Then open the account, set the transfer, pick simple funds, create the rebalancing date, write down the crash rule, then let the system operate. The future version of you will not thank you for waiting until everything was perfect. The future version of you will thank you for starting a process that made money less stressful and life more flexible. That is the real purpose. Financial management is not only about becoming rich, it is about creating choices. The choice to work because you want to, not only because you must. The choice to handle emergencies without panic. The choice to help family without destroying your plan. The choice to retire with dignity. The choice to walk away from a bad job. The choice to sleep better because your money is no longer just sleeping in a bank account while you work 10 hours a day. That is why the $10,000 matters. It can be the beginning of a different relationship with money. Not money as something you chase. Money as something you direct, not savings as a pile that inflation erodes. Capital as a system that grows, protects, and creates options. Not investing as a source of stress. Investing as a disciplined machine. Now, I want to be very clear. No allocation is perfect. A 20 divided by 60 divided by 20 system is a framework, not a law. A 70 divided by 30 stock. Bond mix may not be right for everyone. A younger investor with high risk tolerance may choose more stocks. An older investor or someone with unstable income may need more cash and more bonds. Someone with high interest debt may need to pay down debt before investing aggressively. Someone with dependents may need a larger emergency fund. Someone with uncertain employment may need more liquidity. The point is not blind copying. The point is understanding the roles, safety, growth, opportunity. Every portfolio needs some answer to those three needs. If you design those roles consciously, you are already ahead of most people. Most people do not have a portfolio. They have a pile of reactions. They bought something after a video. They sold something after a headline. They hold too much cash because they are afraid. They hold too much risk because they are impatient. They have no rebalancing rule. They have no emergency reserve. They have no opportunity fund. Then when the market moves, they move emotionally. That is not how wealth is built. Wealth is built when behavior becomes consistent enough for compounding to matter. The system I am describing is not exciting. It is not designed to be exciting. It is designed to survive. And over long periods, survival plus compounding can be extremely powerful. That is one of the great truths of investing. You do not need to be the smartest person in the market. You need to avoid being forced out. You need to avoid panic. You need to avoid concentration. You need to avoid fees and complexity that eat your returns. You need to avoid letting inflation quietly destroy all your idle money. You need to continue long enough for the curve to bend upward. That is how ordinary investors can build extraordinary outcomes. Now, when the portfolio begins to grow, you will feel a change. At first, you check it constantly, then you learn not to. At first, every market decline feels personal. Then you learn that volatility is normal. At first, dividends feel tiny. Then you realize they are signs that the system is alive. At first, the account balance feels too small. Then one day it crosses a threshold, and you understand that the money is no longer only the result of your labor. It is also the result of the assets working. That moment matters. Because once you feel it, saving and investing no longer feel like punishment. They feel like ownership, and ownership changes decisions. You begin to question wasteful spending. You begin to respect time. You begin to see that a dollar spent is gone, but a dollar invested can become many future dollars. You begin to understand that your choices today either strengthen or weaken your future options. This is not about being miserly. It is about being free. Now let us return to the original comparison. You work 10 hours a day for money. If your money sits idle, the relationship is one-sided. You are working for money, but money is not working for you. The goal is to reverse that imbalance. The first $10,000 is not the end. It is the first real base. The safety net protects you. The growth engine compounds. The opportunity bullets prepare you for market fear. Automation keeps you consistent. Rebalancing keeps you disciplined. Learning keeps you aware. Income growth increases the fuel. Patience lets the machine work. That is the system. And if you repeat it long enough, the result can be much larger than the original $10,000. At a 7% annual return, $10,000 can grow meaningfully over 10, 20, and 30 years. Add $200 a month, and the long-term number can pass $300,000 under the assumptions. That is not luck. It is structure. It is time. It is compounding. It is discipline. And that is the difference between money that sleeps and money that works. So do not wait until you feel perfectly ready. Do not wait until the market looks perfect. Do not wait until you understand every advanced concept. Start with the structure, start with the system, start with what you can control. Because 10 years from now, the person you become will either inherit the result of your action or the cost of your delay. And if you want more freedom, more confidence, and more control over your future, the best thing you can do is stop letting your money sleep while you work yourself to the bone. Put it to work. Give it a system, give it time, and let the compounding process begin.